Hello and good afternoon, everybody. Thank you for coming to another Hanson Capital Industrial webinar. This is the 10th one in our series. Today we're focused on the small bay economy, or small bay segment, and how it is the backbone of the economy. Businesses literally cannot function without small bay industrial. First off, these webinar series, if you haven't been here, they are less presentation focused as they are more content and conversational. With me today, I've got Ted Oss, the Managing Director of Investor Relations, Chris Pike, the Managing Director of Acquisitions, and myself, Chris Hanson, the founder of Hanson Capital Group. After we give a little background, we'll dive into the specifics of why this sector of real estate is so functional. It's essential, it's sticky, and it's not being produced. So we look forward to explaining stuff. We want this to be very conversational. If you've got questions, throw them in the chat. We'll answer them either as they come or at the end. And with that, I give it to Chris Pike.
Sweet. Thanks, Chris. A quick background on the firm. The firm was established back in 2008. Chris was buying single-family homes at auctions and packaging them into portfolios that he eventually sold to institutions, as well as buying single-family homes on behalf of institutions. Also was buying existing value-add apartment deals. Between those two lines of business, did a few thousand doors bought and sold across the Sun Belt. Started acquiring industrial assets in 2018 and picked up a lot of speed in 2020 and 2021. Today, our focus is on small bay multi-tenant industrial, as Chris mentioned. So this is where we're heavily focused on building our portfolio today. And part of this presentation, we're going to pull back the curtain on why that's the case.
Great. So quick disclaimer before we start. This information shared today is for educational purposes only and does not constitute an offer to sell securities or a solicitation to invest. Any potential returns discussed are not guaranteed and depend on the company's ability to execute its strategy as outlined in the private placement memorandum. Please conduct your own due diligence before making any investment decisions. Also, we find these webinars are best when people are engaged and asking questions. So if you have anything on your mind, anything you'd like to ask, please send it into the chat. We'll try to get to them as we go through the presentation. Otherwise, we'll be sure to get to them at the end. So today we're going to do a deep dive into small bay industrial, the specific niche within industrial that our Hanson Capital portfolio is built around. We're going to cover what small bay actually means and what these buildings look like, who the tenants are and why they behave differently, why demand is structural and why supply cannot keep up, why institutional capital is increasingly interested, and some of the risks and trade-offs investors should understand when considering this asset category. So first, Pike, could you define small bay for us? What does it look like and what are we talking about physically here?
So small bay, it's typically in the form of multi-tenant business parks, and we're specifically focused on bay sizes under 25,000 square feet. Some investors look at it as true small bay or incubator space, can be a little bit smaller than that, call it like 3,000 to 5,000 square foot bays. But us as a team, we're very much so honed in on anything below 25,000 square feet due to lack of supply. In terms of what it looks like, these are, like I said, business park settings where you see either a larger singular building or a strip of multiple strips of buildings where each building has multiple tenants inside of them, and each tenant has a small office in the front and a warehouse in the back.
So Hanson, what type of tenants do you find in these buildings? Who's actually inside of them?
Well, like the graphic on the screen here, Ted, we've got contractors and HVAC plumbers. The focus or the differentiation between the small bay tenants and I'll say more traditional industrial tenants is really that these are people that are servicing their local areas. So while you may have some distribution or e-commerce and those users mixed in, the backbone of these is people that are servicing just their local area and not just a city, but a subsect of a city or a neighborhood. It's that last mile where there's going to be a bigger issue for those guys to service a customer base that's not super local or move because their customer base and everything is already there.
You see a lot of demand for the product type where you're seeing strong residential growth. So that's customers that are chasing the rooftop growth and want to be close to those customers.
Like, how does it small bay or flex space differ from traditional warehouses?
So small bay versus traditional warehouses, like if you're looking at big box warehouses, developers are typically building one office space per 100,000 square feet, right? So versus small bay, you've got multiple offices within, like you might in that same 100,000 square feet have 20 different tenants in it. So you have 20 offices all with their own access and their own restrooms and their own segmented warehouse. So that you got demising walls that separate each of the tenants. Plus you've got multiple offices. So it's a much heavier build out or much more costly build out for the small bay product versus big box product due to reasons like that.
Hanson, what does a typical small bay property look like from the outside?
Frequently, they're going to be masonry or block construction. They're not usually super tall clear heights. 18 to 20 is fairly typical. And one of the plays we've been doing is taking the traditional masonry stuff and putting stucco or other elements that make it look a little more modern.
Then Pike, since we own a significant amount of small bay, what's the most common tenant profile that we see across the portfolio?
It's going to be these service style industrial users. I think Chris touched on it pretty well earlier, right? Sometimes you'll get some light manufacturers mixed in or some last mile distribution uses, but majority of our portfolio is heavily focused on people that are plumbing contractors or tile installers or someone who might be manufacturing doors or windows. Like I said, really focused on servicing the residential growth or chasing the business behind strong residential rooftop growth.
So small bay tenants are sticky, and we use that word a lot around here. What does it actually mean in practice, Hanson?
Sticky meaning they don't move as much. We compare it to apartments sometimes. Apartment users will move every year if they can get a little discount on rent or 6 weeks free or something like that. These guys have more complex build outs. Their infrastructure, especially if they're manufacturing anything, can be more complex. And as we mentioned, the hyper local nature of their business isn't going to be conducive to moving across town. They're not subject to the same types of pressures that tenants are in a residential capacity, like a new job or kids moving to schools or different things like that. So these are built around businesses that are built locally. Add to that, the cost is not like an apartment or a residential place where you could maybe let your lease expire here and move to the next one and be up and operational. You'd probably have to have a transition time where you're having two places. It's an expensive process and they're reluctant to move. No business owner is excited to move their location, especially when they're repeat.
Once they establish their customer base, they tend not to want to leave that customer base. So it's not even if they wanted to for lower rent or more convenient location for themselves. A lot of times they can't because they've got an established customer base in that area.
Got it. I know we have one tenant in particular, Hanson, in one of our properties in Tempe that's got a unique situation on a building. You want to share that with the group?
The McKinney process or McKinney tenant. So we've got a tenant. They filled up our McKinney building. It's a small suite, 7,000 or 8,000 feet, but they cater to the semiconductor space. So they wanted to be near Intel's new plant. They're paying us, I think, $1.40 in rent. So call it a $10,000, $11,000 a month rent, but they put over $2 million of tenant improvement equipment and manufacturing in there to the suite to make it their home. So when you've got people that are putting that investment into the space so that they can operate their business, and their business is built around the proximity to another business, it's like part of the supply chain. So the odds of those guys wanting to move at the end of and I don't think they did a 5-year term. Pike, did they do a 10-year term or was it a 5-year deal?
I actually believe those guys did 5 years with a 5-year option, right? We gave them a market rate option, but they were very particular about wanting an additional 5-year option regardless of the rate because they likely don't want to. They don't want to leave.
So in their eyes, they want to push for longer term, longer rate, so they have a fixed occupancy cost going into their 10-year future. On our side of the table, part of the beauty of small bays, it's traditionally 2 or 3 years, sometimes on the long end, 5-year lease duration. We agreed to give them a market rate option at that 5-year mark. So we didn't lease it for longer than 5, or we didn't commit to a price longer than 5, which gives us the flexibility to raise the rent more than what I think we would put in 3.5% or 4% annual rent bumps on a deal like that. So 5 years from now, if the rent has outpaced that we go debate about what the new market price is, and we can get a bigger bump for the next 5 years. But when a tenant will put $2 million in, that's more than the expected rental value that they're going to pay us over the duration of the lease. Those guys are not going to trash that to walk away. And that's not just equipment that they pull up and move to the next one. That's specific build out. There was HVAC requirements, electrical requirements, reconfiguration of the suite. That's tenants putting real dollars into committing to our space. And then we can rely on that income and the diversity of that income, because that's a small property for us, but it was one of 5 suites at that building.
Wait, can you talk to us a little bit about what happens to small bay demand during a downturn? Do these tenants disappear? What do you typically see when there's a pullback of some sort?
Just like demand for any other product type, in a downturn, demand can slow, but these businesses aren't going away. Like an easy way I can explain it is, it's a great example for people who live in Arizona. If we have an HVAC tenant who is occupying our small bay business park, their business may slow down, but those services are essential. If someone's AC goes out in the summer in Arizona, regardless of a downturn or not, that person's going to need their AC repaired or replaced. So those businesses don't disappear. Again, just like it can't say maybe they don't bend or demand slows down, but they're essential businesses that are not disappearing in a downturn.
How would small bay demand differ from larger big box, 100,000, 500,000 square foot large format buildings? How would that vary in demand in that type of a situation?
I think it purely comes down to amount of people that can utilize the space. The tenant pool for a 3,000 or a 5,000 or even a 10,000 square foot space is much greater than the tenant pool who can occupy 100,000 or 200,000 square feet. You've got a few select regional or national tenants who can occupy 100,000 square foot space all to themselves and take on that cost, versus you've got a lot of regional, local or regional credit tenants who can occupy those smaller spaces alongside some national tenants who also need smaller spaces. So in general, the tenant pool is much larger for small bay.
What are some of the demand drivers for small bay?
At its purest form is population growth. This is a product type that we have not, in every webinar we talk about it, this stuff is not being developed. It doesn't make a ton of sense to develop it, or it hasn't for the recent past. And as we continue to add population growth, when you have no new supply, but you've got more bodies and more households, infrastructure spending like the TSMC project up in North Phoenix, small bay demand everywhere surrounding that, as all that investment gets made, is going through the roof, and there just isn't a lot of opportunity to put more of this product in place. So it's something that you can buy and hold and continue to see increased income, operational profitability, as there isn't a great new supply side. So that supply demand imbalance is continuing to become more and more imbalanced.
Again, everyone in the audience, if you have any questions, feel free to throw them in the chat. We don't have any yet at this point, but as they come in, we're happy to pause and answer what you have. So institutions are waking up a little bit to small bay right now. So why is the small bay structurally undersupplied, and what's happening on the construction side?
Happy to chime in on this one. It's structurally undersupplied due to the fact that in recent years it hasn't made sense from an underwriting standpoint or return standpoint for developers to build the product. It costs too much to build the product versus the amount of rent the market was willing to pay historically, or at least in recent history. So again, due to the higher cost is associated with what Chris mentioned, is there's lower density setup. You need to have room for drive lanes, more access for more customers, more parking for more customers. So it's a lower density product versus a big box distribution center. They can cover a majority of the lot because it's a singular tenant that needs access to the building. So in recent years, it hasn't penciled due to density issues, alongside the fact that you're having to do multiple office build outs, multiple access points, et cetera. So
like that's it. 100,000 foot building that maximizes lot coverage, that has one SES panel and a few restrooms and a bathroom, versus 20 suites that are 5,000 square feet apiece. You've got 20 electrical panels. You've got 20 office build outs. That's a material increase in the cost. And it's also by definition way less dense. So the 100,000 feet that you could put on, say, a 4-acre site. A 4-acre site of this product, you might only be able to get 60,000 square feet. So there's a lot less revenue potential out of the structure, net rentable square feet you're able to develop because of that lower density requirement for the drive lanes and the access and some of those other pieces. That's why the supply side hasn't been.
And how does infill land scarcity play into the supply picture?
Infill land is tough in major markets that we're looking at anyway. If you go to like smaller tertiary or more rural adjacent markets, this supply demand problem isn't as big because when the dirt's free, it isn't as relevant. But when you're talking about a metro area like Phoenix or Dallas or Houston or Denver, just some of the markets that we're focused in, we're talking about cities that have been built up that don't have a lot of raw land internally, and even worse than just not a lot of infill land being there, this product has been getting torn down very recently. People have still been tearing this stuff down through about 2022 to go build higher density multifamily projects. So we're bringing more and more population into these metro centers, and the easy thing to take down, this stuff was dirt cheap. 5 years ago, when we started buying it, we were paying 70, 80 bucks a foot for it. Today it's trading north of $200 a foot. That's a huge bump. But if you could buy it for 70, tear it down, because multifamily land was trading at 30, 40, $50 a foot, not buildable, just per foot of dirt. So it made sense to tear this product down. So we've actually had the supply side shrinking in some cases. Depending on the year, there's been more that has left the supply pipeline than came in.
That was actually a question we just got from the audience from Saul, but what is the build cost now for small bay and compared to base cost on existing on your last acquisition? So what are we seeing?
So our last acquisition is up in Scottsdale. We paid about $240 a foot. If you were going to build that stuff today, it would be greater than that. We haven't looked at a specific, and I'm not just talking the vertical cost, vertical construction cost, depending on project size. There's a few different ranges, and this would be a great thing to dive in deeper on a one-on-one call if we want to. But you get some economy of scale the larger the project is that you build. The just pure vertical cost, we've been quoted as low as 130 bucks a foot. Now you've got site development, land cost, and a number of other things. And that number has come down even a little bit over the last 12 to 24 months. But another project we bought in April, I can speak to a little bit better. Existing product is trading around 240 to 270 a foot for newer developed stuff. And we went into that project at about 120 bucks a foot, $119 a foot, with our construction and conversion costs coming in all in around $160 a foot. So we're still very set on getting discount to replacement cost.
And I can chime in high level on the Scottsdale deal. We recently acquired it for 240 bucks a foot, like Chris mentioned. Replacement cost in that area is easily going to be north of $350 a foot, because dirt, while essentially non-existent because it's infill land and it's constrained, there are trades happening where people are paying, call it $40 to $60 per land square foot. And then you add that on top of the fact that you're not getting 50% coverage, you're getting probably lower than 50% coverage of buildable square footage. So that alone takes your cost north of, on just the dirt, north of $80 to $120 per square foot, plus the vertical construction cost that Chris mentioned of 125 bucks a foot. Then you got to take into account your leasing costs, your cost of debt while you're working through the development process, alongside soft costs and spec build out costs. So it adds up quickly. Quick comparison for Scottsdale would be buying for 240 versus replacement closer to 350 or greater. And the 350 is a conservative number for sure.
So Hanson, we got a question. Has Hanson developed any flex when you are developing a better class of small bay flex than exists in an area? How do you gauge if the market will support the higher rates you need to charge for it to pencil?
That's a great question. So, and if we can make those not disappear so I can reference it. So here's our view on that. There are some developers that have come in from California that are building some small bay right now. And they are making it for sale product. And this is the developer's debate at any given time. Like the home builders that started building communities for rent. We built a 128 home community in Dallas for rent because it made more sense to do it that way. There's small bay projects being built right now, and their thesis is they're going to do heavy finishes, higher class product, and they're going to go to market starting around $400 a foot. Now, this is on the west side, cheaper dirt, cheaper cost. If we were underwriting that, we're putting their all-in costs around $250 a foot. That seems like a great margin. I am skeptical, and I'm not saying they're wrong, but it's not where I want to put my dollars, because I think our users here, when comparing the quality of, we've got existing small bay product in the area that's older vintage, with a modern front elevation, a modern paint scheme, modern lighting, flooring, all that stuff, it's still very functional. And I don't think the HVAC contractor is concerned with having the latest and greatest brand new building. So I think as a for rent product, I would rather be building at a lower cost. I won't say lower quality, but I'll say less fancy product type. But really, at the end of the day, it's just going to be math. What's the yield on cost? And if we're building for rent and to hold it versus are we building it to stabilize it and resell it, I'm going to use a different lens for both of those. We are actively looking at developing product that would be for sale, and the fallback in that scenario is you rent it. We want to see yields on cost north of 8, meaning all in capital carry cost, all total development costs. We want to see a yield that's greater than 8% annually, and I'll build to that all day because I'd be happy to own it. And we think we could sell that closer to a 6 cap, maybe a 5.5. That leaves a great spread for a profit on the way in. And those projects will probably be coming out later this year, early next year from an investment standpoint.
And to tail on that further, I think the follow-up of that conversation is we're never looking at charging a rent premium above or underwriting a rent premium above what's being accomplished today. You're saying, hey, how do you justify rents for the new product versus what's being achieved with second generation product? Typically, when we're looking at a development deal, we are underwriting rents that are being achieved in today's market. We are not projecting a premium just because we have nicer, newer product. So if you're looking at any future development deal that we may be doing ourselves, or if you're actively looking at someone else's development opportunity, I'd look carefully to make sure that the lease rate that they're underwriting today is actually being achieved in today's market and wouldn't rely heavily on being able to achieve a significant premium just because it's newer product.
Sounds good. You guys okay to move to the next slide?
Sure.
Cool. So we had a question on risk that we can touch on, the segue that we have here, but what are some of the trade-offs and what's the downside of owning small bay?
The downside or trade-off, it's operationally intensive, right? That's historically, aside from being cheaper to develop big box is also easier to manage. So institutions love the ability to deploy capital and at scale efficiently with less management headache, but taking on 100 square feet with 100,000 square feet with 20 tenants is much more difficult to operate than that same 100,000 square feet with a singular tenant. So the trade-off is just management intensiveness.
So how do you handle that operationally?
So operationally, right, you got to have the right systems and processes in place along with the right team in place. And that's both internal team and external team. You need these deals to move quickly. You have people that are looking at a space and they need to move in this week. You need to have a leasing team that's reactive, can get them through the space, have a quick process for approving them as a tenant and getting them into the space quickly, and having the right process to do systems and processes to do that is critical. Similarly, from every other aspect of managing it, right? Having the right infrastructure and technology is critical.
So some of these smaller tenants, they don't have corporate credit ratings. So how do you get comfortable with the risk of signing these tenants to long-term leases?
We still look at financials, and corporate credit's great, but when you've got the diversity of a tenant base, think of it more as an apartment building. If it's an existing business that's already got an established customer base and they're operationally profitable, I'm not as worried about their credit. And with the way rents have been moving, doesn't mean that'll be that way forever. Usually if we have a tenant vacate, we're able to release the space at a higher rent. picture any busy marketplace where the housing people are holding on to their apartments because of the rates that they're at. If these guys fall out, we've been successful at backfilling those spaces at greater rates. And I also would rather have the diversity of a whole bunch of tenants than a single tenant, because a single tenant building that goes vacant is just a painful, expensive place to be. Whereas one tenant on these projects, it's not generally making or breaking the deal.
We also apply tactics like we're not doing a huge TI offering or very tenant specific build out for a low credit tenant, right? Like we limit our costs out of pocket as a landlord if we're working with a lower credit tenant as well, right? So just protecting your basis into the deal when you're dealing with a lower credit tenant is important as well.
What systems or processes make the difference between operators who handles this type of tenant management well versus one who may not, Mike?
So I touched on a few earlier. I think an important one before you're actually operating the real estate is having an efficient process for your acquisition and due diligence, right? Making sure that the plan that you're going out to execute is truly feasible. So that's critical, is just making your front end acquisition checklist that is effective. For example, we have an 84-step checklist we follow to make sure we're crossing all our T's and dotting our I's, and what we're underwriting is actually achievable. Another piece is internally tracking upcoming renewals effectively or upcoming terminations timely and effectively, and making sure you have the transition process really dialed in, whether it be with your leasing team or your general contractors, right? Your general contractors are an external team member that really has to know your make-ready plans. They have to be able to efficiently price out make-readies when you have tenants that are noticing you that they're going to vacate, and they have to be able to turn units very quickly. So having a clean system of, okay, we've got a tenant who is giving us notice they will not be renewing. You need to have that communication line really dialed in, that process really dialed between your leasing team, your contractors, and your manager, so that, okay, the leasing team is out marketing this thing immediately. Your contractors are quoting it and can start construction the day it vacates and can complete it within 30 to 45 days. And that your management team is overseeing and operating all of it, right? So you need to have an efficient process for yourself and your external parties. What I touched on earlier, you also need to have speed for leasing, right? These deals happen fast, and you can't sit around for 2 weeks and make a decision on a tenant. You need to, if you get an offer, you need to be able to respond quickly and have a process to qualify and get a lease signed quickly. Otherwise, you might lose them to some competition in the market. And then finally, like your accounting infrastructure and processes are critical. Like we leverage a software called Yardi. It's the institutional standard for property management, asset management, and it fully integrates all the way from customer facing or investor facing portal all the way down to tenant facing portal. So having a sound infrastructure both on the technology front and your internal team front is critical for operations as well.
I mean, suffice all that to say, it's not rocket science, but it's a lot more operationally intensive, more like running a business than a single tenant industrial property. You've just got to be on point with all those systems. Recently, we hired a managing director of asset management that came out of the market leader nationally in small bay. And she's bringing, I'll say, more of that speed, actually a lot of validation to our internal processes, but having somebody who's dedicated to doing that full time. We have almost 400 industrial tenants at this point. So being able to have all that stuff systemized and optimized to be functioning really smooth every day is a competitive advantage.
Question from Steven. Since more management is required, what project size by square foot is feasible for small bay projects to be profitable in minimum and maximum range?
I'll take that one. That's a great question. And it's something that we talked about a lot in multifamily. The rule of thumb there was like 80 to 100 units was a minimum size where you could effectively manage it, i.e. having leasing and maintenance staff on site that could be running the property every day. And while sometimes the these deals that were 30 units or 40 units or 50 units might look compelling. Managerially, it's too big to run yourself, like a fourplex or an eightplex. And hopefully none of us on this call are trying to actually operate and run our own small deals. But in small bay, I would say professional management is critical. Our largest project has 114 tenants. It's 350,000 feet. That supports on-site staff and does that great. But unlike apartment units, because the tenants are more B2B as opposed to business to consumer, they don't need the same handholding day in and day out. So as a minimum, I don't think there's a maximum, and on a minimum, 4 or 5 tenants gets you pretty good diversity. And I think you could probably oversee that yourself if you were just getting started. And I'd say up around 20, I want to have people taking care of it for me, just depending on how comprehensive the day-to-day operations are there. We'll also use day porters, which is like almost like landscape and little handyman stuff that can bounce around. But we try and aggregate a few properties and make that a central hub, and we can run the rest of it from there. And we have staff in Houston, or full-time on the ground staff in Houston, a few people there, and we're totally comfortable with them running our Dallas and other Texas properties from there. So you don't need the same handholding that you need day to day with multifamily.
And another way to frame it is we look at a market, if we already have operational scale, we will look at smaller deals in those markets because they can bolt on effectively with the management that we already have in place. So again, we will look at smaller deals, but we're really focused on, are we established in the market and is it operationally efficient or not? Hard to put a specific, hey, this minimum square footage required for us to go after a deal. There's a lot of pieces that go into it.
Our constraint is probably going to just be deal size, from the fact that we've got a corporate overhead and structure where it's not going to make sense to go raise capital from outside people to buy a deal that's less than maybe $5 million, just because it's not big enough. There's not enough revenue involved for margins to cover overhead.
Makes sense. Let's talk about, from an investor standpoint and checklist, and what limited partners or potential investors should look for when evaluating a small bay deal.
Again, just because of what we've been focusing on a lot from this slide in particular, like you want to look at track record of like execution ability, like have they owned this product type in the past and executed on it. Alongside that, understanding the team. This is a team effort on this, not one single individual on our team can say, hey, they drive the true performance of this asset. It's a true team effort. So understanding who the team is and their capability and background is important. One that's really easy that we always look at is location, right? Location, having easy access to a freeway or short distance to a freeway. Ideally, maybe it's got some exposure or quick access to a major thoroughfare as well. Is it near strong residential growth? What does the competing inventory look like in the area? Is there new inventory coming online? Is there existing inventory and what rates they're looking at? So those are a few. Hanson, I don't know if you got any more, but.
No, I think that's great. Just the diversified rent roll is probably another thing that I think is important, just for peace of mind.
So red flags, what's one of the biggest warning signs that you see on small bay? And that's one of the questions from the audience, is the biggest risk to the small bay strategy.
Brian, that's a good question. My biggest fear with small bay, and I think it's pretty small, but if we're not acknowledging risk, I think we're not being honest with ourselves, is because we've seen so much rental growth in America, we have a tendency to develop what works. And this is working really well, and it hasn't penciled to develop. Today, it looks like it does. If we overdevelop it, which we're not in a phase where it's like money's falling out of the sky and everybody's developing it yet, but I was at the ICSC retail conference in May, which is the biggest retail investor conference, banks, developers, institutions, everybody there. And I'll say half the retail developers that I talked to and asked what they were up to said, we're really looking at this small bay industrial stuff. Now it's not as easy as just pivot. Okay, we're going to start building this now, and like they're going to go be a true competitor. But if people get more innovative and figure out a way to bring down the cost of construction, and which we tend to do in the commercial real estate space, oversupply could cause an issue. I don't think that's like structurally going to become a problem in the real short term, but it's something I'm keeping an eye on. Mike, any risks that you'd want to highlight?
No, at least in terms of like red flags, I think that's risk from a overall standpoint in terms of like our macroeconomic standpoint. I think the red flags as it relates to if you're interviewing other sponsors, things to look out for, it covers it on the slide, but just making sure they have a strong track record, what their team looks like, and is their team able to have a history of execution, having a clear business plan or a demonstratable business plan, right? Like if you're looking at a value add or a mark to market strategy, you get really clear on comps and making sure that their business plan is clear and achievable. Keep an eye out on deferred maintenance and capex. Like a lot of times, if you're buying something that's been owned by a long-term owner, you need to make sure that they're also accounting for any unanticipated roof or HVAC replacements that might be showing up. And then also, again, like I said, local leasing network, it's a team sport, not just internal team, but external team. If they're leveraging local boots on the ground for leasing with external brokerage shops, make sure the people that they're utilizing have a strong track record of execution as well.
And Pike, we don't do leasing in-house, correct? Can you speak to that real quick?
We handle renewals. Okay, a lot of times we'll handle renewals in-house. Like we're already very close with all these tenants. We're talking to them month in and month out on issuing invoices, collecting rent, handling maintenance issues, talking to them about their growth plans, right? So we've got strong relationships and a lot of times handle renewals conversations in-house because we believe we can handle them more effectively than maybe a third-party broker who doesn't have that relationship with those tenants. But for outbound or new leases, we are always leveraging third-party broker relationships for that effort. These guys are pounding the pavement, talking to tenants consistently that are outside of our business park. Maybe they've placed those tenants in the past and have maintained a relationship with them and are taking them to other business parks, et cetera. They have the marketing systems and processes down along with the relationships with the tenant base that might not be within our own business park already.
Sounds good. So a question from the audience: if most competitive properties in the area are modified gross lease, does your small bay need to be the same lease type? Preference would be triple net, but need to still be competitive in the area.
I'll speak to that one, Mike. So there are, depending on different markets, there are some traps in this because modified gross is going to bring people in with a lower sticker rate. We convert everything to triple net. And where this can get challenging or confusing is when California, for example, if you buy something, you get a reset on the property tax value. So somebody who's held something for 10 or 15 years might pass along triple nets of 15 cents a foot for taxes, whereas a new acquisition might take 50 cents a foot for taxes. So we're going to normalize those and show the math in our leasing to say, hey, even if you're paying this today and it's modified gross, here's where all those numbers shake out. Here's where it is triple net. And as Pike mentioned earlier, we're underwriting not to set new records. We want to have a best in class property that shows clean and is excellent, but we're going to underwrite to the low range of the market. And when we outperform, that's great. We're never going to be chasing peak rents. Now, we're going to try and get it with all of our leasing activity, but that is not how we underwrite. And we found that keeps us competitive in the area consistently.
A good example of that is on the Scottsdale deal we mentioned earlier. We're underwriting market rents at $1.85, and we're seeing people in the area achieve as high as between $2 and $2.10 a square foot, right? So we know, hey, we're solidly in an achievable lease rate, but we also know there's more expensive stuff out there. And if we can get there, great.
Question: you guys are talking about big cities. Please address 2 and 3 tier cities.
So second and third tier tertiary markets, I think just like any market, I think we're looking at 24 metro areas, despite being focused on 8 states today. We're going to look at the supply demand and the rental rates and really dive in and study what those look like. So when it comes to any market, whether it's a primary market or not, understanding the supply demand balance of that market, which you're going to be able to understand from the vacancy. If the local submarket is 97% occupied and you've seen rents have trended up over the last few years, you're probably a little undersupplied, but you should also check with the municipalities and see what's under permit to be built. Those basics of assessing the marketplace are going to be in place regardless of how populated or unpopulated the marketplace is. And you've got to go get your construction costs to understand and compare to the existing product to see if it would make more sense to be buying the existing stuff or build it. We always say if it's cheaper to build than to buy, you should be building. And if it's cheaper to buy than build, you should be buying. We always want to be on the right side of that equation. And it doesn't really matter whether it's a primary market or not.
Sounds good. How does leasing look now in 2026, Pike?
That is a question it's a loaded question, very much so dependent on the market and even the market, the sub-market it's in. Like we could talk about Phoenix, and Phoenix demand is strong, but it's a tale of different sub-markets and it's tale of different bay sizes, right? Like big box product in Phoenix has been oversupply, overdeveloped, and now has oversupply. And therefore, that inventory is still seeing leasing velocity, but the vacancy rate is high due to oversupply. So leasing velocity is still strong, maybe not as strong as it was in 21 for big box, but there is still leases that are happening. But given there's so much supply, the vacancy rate is still pretty significant, especially in certain submarkets, reaching as high as 12 to 16%, depending on the submarket. Versus like infill location in Phoenix with a small bay size of 1,000 square feet where there's not a ton of competing inventory. Or I guess you go look at the Scottsdale as an opposite end of that spectrum, right? Small inventory in Scottsdale can be as low as between 2 and 3% vacancy rate because there's no new competition that has been built in recent history because there's been no land available. And there's minimal competing inventory in a submarket where there's strong demand. So broad question, like I gave you a very dynamic answer, even within one metro, and even metro to metro, that's going to vary slightly. But in terms of, I think it comes down to what Hanson mentioned, look at the macroeconomic trends, and that will typically also follow along with the leasing story. If you've got population growth and you've got low supply in a market, your leasing velocities tend to stay strong, even in a volatile macroeconomic environment.
Hanson, question here. If an LP could only ask a sponsor 3 questions about their small bay strategy, what should they be?
I start with location. We've hit it a couple times, but why this location? What does the surrounding inventory and competition look like? That should be the foundation of a real estate decision. I'd want to see the comps that the assumptions are based on. Spreadsheets are relying on assumptions, should be relying on market data. Show me the sale comp, show me the rent comps. I want to see the product. I want to see what it looks like. I want to see what our subject looks like so that I can compare those two. And then lastly, who builds up the team that is going to be operating the asset? What's their background? What's their experience? What's their track record in operating these assets? If you can get comfortable with the location, you can get comfortable with the underwriting, and you can get comfortable with who's doing the operations, odds are in your favor. We get all the questions, Ted?
We're all through.
Okay, 50 minutes. That's great. Really appreciate everybody taking the time to spend this hour with us and learning about why we're so focused on small bay industrial. If you're interested in learning more, we've got a QR code here, schedule a one-on-one with Ted. We look forward to doing many more deals through the end of this year and through next year. We're really excited about where this sector is and is looking ahead. And thanks again for your time.
Thanks, guys. See you.
Yeah.